Welcome to today's Explainer. I'm going to be your mentor today, guiding you through one of the most powerful, time-tested secrets to protecting your money in the stock market. We're going to look really closely at a concept that has served as the absolute bedrock for some of the most successful investors in history. It's called the margin of safety. Now, if you've ever felt anxious about market volatility or wondered how the pros managed to avoid those catastrophic losses, well, you're in exactly the right place. So, grab your notepad because today we're going to build your investor's shield.
Okay, here's the quick syllabus for today's masterclass. We'll kick things off with a welcome to value investing, then contrast intrinsic value with price. After that, we'll dive into the famous bridge analogy, uncover some forgotten layers of safety, and wrap it all up with our masterclass conclusion.
All right, let's jump right into Section 1. Welcome to Value Investing Forged in Crisis.
To truly understand how to protect yourself, we've got to travel back to an era when investors desperately needed a shield. It's so easy to look at today's charts and completely forget that the foundational rules of investing weren't created during massive, easy bull runs. Now, they were forged in the fires of absolute economic devastation. This excerpt here is from Benjamin Graham and David Dodd's seminal book, Security Analysis, written right at the start of the Great Depression. The book literally calls the 1927 to 1933 period an extreme laboratory test for investing. Because of the unprecedented losses they were seeing all around them, Graham and Dodd realized Wall Street's old habit of just looking at earnings trends was fundamentally broken. Investors needed a completely new survival guide. As a quick aside, Warren Buffett actually prefers the 1940 second edition of this book, specifically because it refines these exact safety lessons after observing a full decade of economic pain.
As your mentor today, the very first lesson I need you to internalize is the hard line Benjamin Graham drew between true investing and mere speculation. Just look at this comparison. An investment operation, according to Graham, is one which, upon thorough analysis, promises safety of your principal and an adequate return. That's it. If your actions in the market don't meet those strict requirements, say, if you're just following a trend or crossing your fingers hoping a line goes up, you are not investing. You're speculating. Honestly, you're gambling. And in the stock market, gamblers eventually lose their chips.
Let's move on to Section 2, Intrinsic Value versus Price, Finding the Disconnect.
Now that we know the difference between gambling and investing, we have to completely rethink how we look at a stock's ticker price. This is the core mechanic of how we actually achieve safety. As Graham plainly states right on page 12 of his text, there is no automatic relationship between value and price. Zero. Just because the market slaps a certain price tag on a stock definitely does not mean that's its actual intrinsic value. You see, the market is driven by human nature. It's driven by wild optimism, crushing pessimism, and buyers and sellers making highly emotional decisions. The true intrinsic value of the real-world business operating behind the scenes is very often completely disconnected from that daily ticker price.
And that brings us to the crucial point of this explainer, this definition right here. Your margin of safety is simply the gap you create when you buy a stock for significantly less than what its underlying business is actually worth. Think about it like this. If you calculate that a business is fundamentally worth $100 a share, but the market is emotionally depressed right now and offering it to you for $60, that $40 gap, that is your margin of safety. It's the entire core thesis of value investing. Preservation of your capital above all else.
So how on earth do we actually find that intrinsic value? Well, over the years, Graham refined his methods and gave us a really handy heuristic formula. Here's how it works in plain English. You take a company's trailing 12 months of earnings and multiply it by a base price-to-earnings ratio of 8.5, which is what you'd assign to a company with zero growth. Then you add 2 times the expected growth rate over the next 7 to 10 years. Now, don't worry, you absolutely do not need a PhD in math for this. The main thing you need to take away here is that intrinsic value is grounded in actual real-world earnings and reasonable growth estimates. It is never, ever based on hype.
Once you run the numbers and calculate that intrinsic value, the practical application is simple. You demand a discount. You never pay a full dollar for a dollar's worth of value. For really high-quality, stable companies, value investors usually want to pay maybe 90 cents on the dollar. But for more speculative, riskier stocks, you should demand up to a 50% discount, literally paying only 50 cents for a dollar of value. That deep, deep discount is exactly what protects your capital.
Which brings us to Section 3, the bridge analogy, visualizing protection.
Formulas are great, but visualizing the risk is what truly keeps you disciplined. So let's look at an incredibly simple yet powerful mental model championed by Graham's most famous student, Warren Buffett. He famously explained the margin of safety using this engineering analogy. When you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. I just love that. This visual perfectly captures why we never cut our estimates close. You don't try to buy a business worth $83 million for $80 million. No way! You leave an enormous margin to protect against your own miscalculations and, of course, inevitable market downturns.
Why do we need a bridge that ridiculously strong? Well, because calculating fair value is honestly an imprecise art. You can study all the balance sheets in the world, but the future is completely unknown. That extra capacity, that 20,000 pounds of unused support on your metaphorical bridge, gives you crucial room for error. It is literally the thing that keeps your portfolio from collapsing when your calculations are slightly off or when a sudden global crisis blindsides the market.
Let's level up. Section 4. Forgotten layers of safety. Playing 3D chess.
For the advanced portion of our masterclass today, we need to look beyond just buying stocks cheaply. Finding a low price is critical, for sure, but it's only one dimension. Modern analysis by firms like Fenimore Asset Management shows us that investing is multidimensional. They call it playing 3D chess, not checkers. The market often completely forgets that a margin of safety isn't just about a cheap price, it actually relies on 3 forgotten sources of safety: balance sheet strength, sustainable growth, and a competitive moat. Let's break these down. The very first layer of safety here is purely about survival. Think about it. A cheap stock means absolutely nothing if the company goes bankrupt. Companies with low debt and strong balance sheets have the capital flexibility to survive massive disruptions. Think of the 2008 financial crisis or those sudden economic shutdowns we saw during COVID-19. But here's the best part. They don't just survive. A rock-solid balance sheet allows a company to play offense. They can swoop in and buy up struggling competitors or invest in major new technology at the exact moment everyone else is panicking.
Then we have sustainable growth and competitive moats. When adept management teams smartly reinvest their cash flows into a business that has a really strong market position, a moat protecting it from competitors, the company's earning power grows organically over time. This is a massive multi-dimensional safety net. Because of this sustainable growth, a stock that initially looked like you paid a slightly expensive price might actually turn out to be an absolute bargain over the next decade as that intrinsic value just skyrockets.
And finally, Section 5, the Masterclass Conclusion, Your Investor's Shield. Let's bring it all together. As we wrap up this explainer, let's review the core tenets you need to walk away with to ensure you're truly investing and not just throwing darts at a board. First, always distinguish true investing from market speculation. You do this by relying on fundamental analysis of actual balance sheets and earnings, not whatever hype is trending on social media. Second, you must absolutely always demand a discount between the market price and the intrinsic value. And finally, look for that multidimensional protection we just talked about. Buy businesses with sustainable growth and strong competitive moats. By combining a favorable purchase price with underlying business strength, you're building an impenetrable shield that not only protects you from devastating losses, but perfectly positions you for incredible long-term wealth.
So, I want to leave you with this final challenge as my student today. Look at your own portfolio right now. Look really closely at what you own and ask yourself honestly, is your money protected by a true margin of safety? Or are you just crossing your fingers and hoping the bridge holds up when the next 30,000-pound truck rolls into town? Thank you so much for joining me on this explainer. Keep analyzing, stay incredibly disciplined, and I'll see you next time.